Okay, good morning, everyone. Thanks for making it to this another lecture session. I trust that you had a great weekend and that your week has been going well. Before we begin our little session, our little thought for the day, as usual, and today this one is saying, there's no elevator to success. You have to take the stairs. So we're going to sweat a little bit, but we'll get there and we'll be healthier too at the end of the day. We have to sweat it. So guys, where were we last time that we were together? We are looking at financial statements. And we said that as per IAS 1, the full set of financials include our income statement, our statement of owner's equity, our balance sheet, our statement of cash flows, those 4 statements. And then we said we are doing financial accounting. So we know that persons are going to be using these statements to make decisions about the entity. Remember we said they want to know, should we invest in this business? Should we lend to the business? So we said in our discussion, sometimes there are things that are not so explicit in the statements, but persons need to know these things to help them in making their decision. We said that these things are material. Please check your microphones, guys. So whatever is not explicit, and we think that they need to know those things, we need to place them in what we call notes to the financials. So we started. Yes.
Good morning.
Good morning.
I'm just wondering why class isn't face-to-face, given that the room is up and running now.
That's too big.
You read
Pardon?
the posting I made?
No, I never saw it.
Okay. What happened? This stream is way over the limit. I think when it was set up online, they forgot to cap it at capacity. So the room cannot hold 100. We have 168 students registered for the stream.
Okay.
The room cannot hold.
Okay.
To you in the note, there are 5 streams. So if you feel more comfortable, you can attend any of the other 4 streams that are face-to-face, because there is space in those rooms. All right? Because we cap each stream at 160. So SSLT can hold over 300. So more persons can go to those rooms. Yes, Alexia, and guys, please, let us not waste time on this now. Alexia, your question, and then we go.
Okay, Miss. Not all persons that have registered will be attending class though, so I don't. And is it that we're going to be online for the entire semester?
That's what I said to you, Alexia. If I can get the room to get a bigger room, then so be it. But I can come to SR10 if you so desire. People will have to stand if you don't mind.
But not all people will come to class that who have registered.
But I'm saying to you, if I come and it's packed to capacity, nobody complains. All right.
Okay.
So we see how it goes. All right, so the full set of financials, our income statement, our statement of owner's equity, our balance sheet, our statement of cash flows, and the notes. So the income statement, our income statement, remember we said that the income statement and the statement of owner's equity, those statements speak to the performance of the organization, the performance of the entity. The balance sheet and the statement of cash flows, they speak to the financial standing of the business. So our income statement, several names for it. Some refer to it as a statement of profit and loss. Some say the statement of earnings. Some say the statement of operations. Now, what is it about the income statement? It speaks to the revenues and the expenses of the entity. The difference between the revenues and the expenses is referred to as the net income or the net loss. If revenues are greater than expenses, we say we have a net income. And if it's the other way around, we say we have a net loss. We said in preparing the income statement, we could do it either in single step or multiple step. For our midterm assessment, we'll be doing a single step income statement. For our final assessment, we'll be doing a multiple step income statement. So what does our income statement look like? We have our heading, remember? And notice it says for the year ended, because we are looking back. So we start with our revenue, single step. Then we take out our expenses and the difference, our net income or our net loss. So next we turn to look at the second statement, which is the statement of owner's equity. So the statement of owner's equity simply shows the change in owner's equity during the period. So heading, same. Name of company, statement of owner's equity for year ended. So in this statement, it shows the change in owner's equity. So we start with our beginning capital. Now, what is this beginning capital? And by the way, when we actually start doing this statement, we're not going to be using the word beginning. We're going to be using names and dates. Beginning capital defined is what a business would have accumulated from prior years' operations. So the fact is, if a business has just started, if the business has just started, then it means that the beginning capital would be zero. If the business has just started, our beginning capital is zero because you would not have accumulated anything. So what the owner puts in would be investment. And then net income or net loss, as the case may be, is added in. Take us to a subtotal. Then out of this, we take withdrawals or drawings. Remember, we said before that drawings is not a business expense. It is what the owner would have taken out of the business for his or her personal use. And at the end of the day, we end up with our ending capital. So that is our statement of owner's equity. In a corporation, refer to it as the statement of retained earnings, but we'll look more at that later on, of course. The third statement is our balance sheet. Now, remember we say the balance sheet speaks to the financial position of the business, and notice here it is at a particular point in time. And it is important to note that every single business event or business transaction is going to change that financial position. So sometimes they refer to the balance sheet as your position statement, or your statement of financial position, or your report of financial condition, whichever term that they use. Now, this balance sheet reflects the accounting equation. Remember, the accounting equation says that our assets must be equal to our liabilities plus our owner's equity. And this is just giving you a snapshot of your assets, liabilities, and owner's equity at a particular point in time. Now, this balance sheet can be arranged in either the account format or the report format. For our midterm, whichever of the two that you use will be quite okay. But for our final assessment, we want it in the report format. But we are going to be going through, and I'll be demonstrating both of them to you. So using the account format now, notice the heading. You notice all the wording of the heading as opposed to the other two statements, the performance statements. Name of the company, balance sheet, at. Remember, it's the financial position of the business at a point in time, reflecting the accounting equation. So we have the assets. Remember, typical assets. All our assets listed there. And at the end of the day, we total to arrive at our total assets. On the other side, liabilities. Examples of liabilities. This is by no means the entire listing. And when we total that, we get our total liabilities. Then now, our owner's equity. And notice now, guys, this owner's equity is the ending owner's equity that is coming from that statement of owner's equity that we just did up. And at the end of the day now, we have total liabilities and owner's equity. So assets will be equal to total liabilities plus owner's equity, the accounting equation. Now, if you notice here, remember we went through and we looked at the breakdown of assets, the breakdown of liabilities. Remember we said that assets can either be current or non-current. And if you look at the asset side here, our current assets will be what? Can you give me examples, the current assets that are listed there?
The cash account receivable, stationery.
Stationery.
Beautiful. Cash, account receivable, notes receivable, stationery, and supplies, all current assets. And the non-current assets then would be our motor vehicle and the building. Now, what you need to remember about the assets, our assets are listed in order of what we call liquidity. Remember that word. Assets are listed in order of liquidity. The most liquid asset here would be our cash. And the least liquid would be our non-current or fixed assets. Our liabilities, how are they listed? They will be listed in the order in which they are due. That's how they list them. All right? So remember, guys, the balance sheet reflects the accounting equation. Now, for some of us who have done accounts before, you may be familiar with a particular formatting layout of the balance sheet, whether it be the T or the report, how you set it up. I said to you last week that the expanded accounting equation is a very powerful equation because it has wrapped up there all your statements. And so I want us to revisit this equation. Remember that this was the expanded accounting equation. Our non-current assets plus our current assets is equal to current liabilities plus long-term plus, remember, owner's equity is affected by additional investment, revenues, expenses, drawings. So the first statement we looked at was the income statement. And remember we said that in the income statement, we compare our revenues with our expenses. So notice right here, that's your income statement. Yes? In our statement of owner's equity, after we prepare the income statement, we go next to the statement of owner's equity. That statement of owner's equity started with the beginning equity. We added the additional investment. Then we added the net income or the net loss, and then we withdrew the drawings. So see there, that's a statement of owner's equity. So to prepare the statement of owner's equity, we end up now with the ending owner's equity. Then the next statement we're going to do now is the balance sheet. So see the rest of it there. So you don't see this restatement right in front of you, right there tied up in that expanded accounting equation. All three statements are there. Now we could go further and fix that balance sheet another way. Look at what we're going to do now and remember your math. You're going to have here non-current assets plus my current assets minus my current liabilities is equal to my long-term liabilities plus my owner's equity. Not true? Now, notice I've put the current stuff together. Current assets, current liabilities. In any business, guys, we need to pay attention to that part of our capital, because the difference between the current assets and the current liabilities is what we call the working capital. Remember, current relates to the 12-month period or the accounting cycle. So when we talk about the working capital, it's just as the name said. It is the portion of capital that is working, helping us to generate our income. So that's the working capital. So those of you who have done accounts before, you would remember this format, because the non-current assets now plus the working capital give you your total net assets. Now look on the other side. We know that a business is financed by one of two sources, or by two sources, or can be financed by one of two. Yes. What are the formats of financing for a business again?
Debt and equity.
Debt and equity. So, you know, she says it that. Debt and equity. So look, guys, the top format for the balance sheet, that's the US format. And this other one here is the UK format. Now, the standard does not prescribe a format or order in which you present the items in the balance sheet. So if you do it the US way, fine. UK way, fine, but be consistent. I notice sometimes in assessments, persons mix up the two formats. Well, whichever you are comfortable with, you stick with it. All right? So that is for the balance sheet. Now, the next statement that we say the full set of financials include will be the statement of cash flows. Now, our statement of cash flows, guys, in business, we say cash is the lifeblood of the organization. It is what gives life to the organization. So what is this statement of cash flows? It is explaining to us how cash changed during an accounting period. In other words, where did cash come from and how it was used? When cash comes in, we call it an inflow. When we use up cash, we call it an outflow. Now, in the statement of cash flows, you're going to find 3 categories of cash flows. Firstly, we have what we call operating activities. Operating activities relate to the operation of the business. You remember we talk about the statement of operations? Yes, the core activity of the business. Then we have what we call investing activities. And then we have what we call financing activities. Now, looking at these 3 activities, guys, which of them do you think would be the most important? Operating, investing, financing. Which one you think is the most important?
Operating.
Operating, because that one is focusing on your core. Operating, the income statement. Remember, guys, we're dealing with cash. So remember, you're talking about revenue related, expense related. So I thought to myself that the best way to explain this statement of cash flows to you is to actually give you a little demonstration of that statement of cash flows. Remember, we are looking at cash. So the statement has 3 sections, as we said. So we're dealing with the cash flows from operating activities relating to the income statement. So what are some of these activities that we're speaking to? First, cash received from customers. Notice that will be money coming in. And what I do in this statement, when money is coming in, I use green for it. Going out, I put it in red. Somebody's microphone is open. Cash paid to suppliers. Wages and salaries of employees. Payment for utilities. Those are expenses, outflows. Listen to these now. If you take a loan and you're paying interest on the loan, it would fall under this category as well. If you made investments and you earned interest on the investment, it would come here. So income statement related. Dividends paid out would fall here so too. And after you pick up all of them, guys, you would total them up. And if at the end of the day it is positive, we say it is what is generated from operating activities. If it is negative in red, we say it is used for the activity. But don't worry yourself, because we're not going to pressure you to prepare. I'll talk to that in a bit. Investing activities. When we talk about investing activities, typically We are dealing with things relating to acquisition and disposal of non-current assets, plus other investments that you may have made. So, if you purchased property, plant, and equipment, non-current assets, that's an outflow. Remember I said to you last time, non-current assets, you never buy them to sell them back, but you could have sold them after a while. So what you get from the sale, the cash that you got from the sale, notice I don't say it's a gain or the loss on the sale, it is the cash. We're doing a statement of cash flows. That would fall there in under investing activities as well. Now, guys, if you gave loans, notice if the business gave loans to employees, that would be an investing activity. If the business gave loans to employees, that's investing. And that would be an outflow. When you collect on those loans, that would be an inflow, collecting the principal on those loans. That would be an inflow. And then you total up that for your investing. Then you go to the financing activities. Now remember we said, a business is financed by either debt or equity. So when we talk about financing activities, it must be, we are speaking to things that impact owner's equity, or we could say it's a cash related to sustaining the business. So the first thing that would come to mind, investment by the owner. That would be cash coming in, withdrawal by the owner, cash going out. Look at this one now. If the business got a loan, that would be financing coming in. When payments are made on that loan, principal payments, that would be an outflow on the financing. So notice, guys, when we talk about the loan, the interest portions is on the operating, but the principal related portions, if it's a loan that you gave, it's going to be under investing. But if it's a loan that you got, you meaning the business, it's going to be under financing. So remember, you have to read good. Is it that the business gave the loan, or is it that the business got the loan? If the business gave the loan, it is investing. If the business got the loan, it is financing. Are we there? If it is a corporation and the corporation issue shares, the proceeds from the issuance of shares would go under financing. Yes? So remember that, guys. We pay out dividends to the shareholders right there under financing. So at the end of the day, we add up the subtotals for the three sections. That will give us the net increase or decrease in cash for the period. Then we simply take the opening cash balance, add it to that net increase or decrease, and that should take us to the closing cash balance. So that is all there is to the statement of cash flows. Now let me say it from now. We are not going to require of you the preparation of a full statement of cash flows. No, we're not going to say to you, you have to do up a full statement of cash flow. But we can give you a listing of activities. And we could ask you to work out the cash flows from operating activities. So you have to be able to identify what goes on the operating, We could ask you to work out the cash flows related to investing activities. You have to go through the list and pick up those and total them up. So you have to know whether they are inflow or outflow and then net them off to get the answer. Multiple choice questions will be there in relation to the statement of cash flows. So notice, guys, the order in which we do the statements, and it happens every time. Income statement first, followed by the statement of owner's equity, followed by the balance sheet, followed by the statement of cash flows. All right? So the last little one we're going to look at now, notes to the financials. Now remember, these are things that people need to know. So those of you who have done accounts before, you remember you have something called depreciation, and there are different methods of depreciation. Easier, so you spell out and tell the people who are using the statement, what is the method that you use for depreciation? You have inventory, you value inventory. What is the method you use to value the inventory? You have a pending lawsuit. It not happened yet, but chances are it can go either way. People need to know about it. So all your accounting policies and other explanatory information, this is where you put them, in the notes to the financials. All right? Now, guys, leaving this point, our focus will now be on preparing the set of financials, namely the income statement, the statement of owner's equity, the balance sheet. So remember, I tell you, in your assessment, you'll be asked to prepare these three statements, but you must be able to identify the items that would appear in the various sections of the statement of cash flows. So now then, in order for us to prepare these statements, guys, we need to understand what we call the financial accounting cycle. So what is this financial accounting cycle? Since we say we're preparing the statements, it must be the process by which accountants prepare the financial statements of the entity, and that is in relation to a specific accounting period. So like, for example, we could say we're preparing the financial statements for 2021. Now, in order for us to be able to do that, guys, and I'm going back to these basics, especially for persons who are doing accounting for the very first time. So here are some things that we need to know. And we're just refreshing those who have done accounts before. So the first thing we need to look at, what are the types of accounts? What are the types of accounts? Stay with me now. On the one hand, we have what are called personal accounts. On the other hand, we have what are called impersonal accounts. Now, the impersonal accounts are further broken out into what we call real accounts and nominal accounts. So we have personal and impersonal the impersonal, real, or nominal. Now let's focus on the personal accounts. Those can be further broken down into what they call natural, artificial, or representative. Now, when you see personal, it must be accounts that relates to persons. So, for persons, I could see Abigail, a Johnny, Brandon, those are personal. J Stone, personal, those are natural. Whether it be we owe the business, or the business maybe owe us, but the names are there, so they are said to be natural. Artificial, no. You would know artificial, don't. Remember, we talked about corporations. So in light of any business would be artificial. So like if it relates to like say an institution like UWI, Black Limited, that's what they call artificial. Representative now. Let us say that the business owes salary to employees. Those of you who do accounts before, remember they would call that wages payable. Not true. You owe an entity something. That is representative. Drawings, and I want you to make sure you underline drawings. Drawings would fall into this category too. So remember, accounts that relates to persons, firms, corporations would fall under personal. So typical examples of personal accounts: accounts receivable, accounts payable, owner's equity, drawings, they relate to persons. All of those accounts, they call them personal accounts. Real accounts now. Real accounts, they can either be, they relate to assets, and they can either be tangible or intangible. Tangible assets. The first one that you think about is what? Tell me a tangible asset.
Money.
Money, cash. Tell me something else that is tangible.
Stationery.
Stationery, yes. Anything
Building.
else? Building. What you call the group with building in it?
Fixtures. No.
Fixtures come in that group too.
Property.
No. Assets.
Property come in that group. What you call it, baby?
PPE.
Assets.
Non-current assets or property, plant, and equipment. Yes. Now, this one is for my accounting people. Give me an example of something that an asset that is intangible.
Goodwill.
Beautiful. Goodwill. Beautiful. So your real assets, your non-current assets, your cash, your supplies, your inventory, your goodwill would be intangible. Those are real accounts. Now, when we talk about nominal accounts, nominal means that they're there in name only. Not true. In name only. They lack tangibility. So our nominal accounts would include revenues, expenses, gains, losses, and see I put drawings there too. So you notice drawings up there saying personal, but drawings down here saying nominal too. So watch the reasoning now. They are there in name only. Now, why is it that drawings would fall there so? Let's talk about it. Now, if you look up there, the examples for personal accounts and the examples for the real accounts, we look at the statements already. Which statement you find those accounts in? Talk to me. Kind of ignore the drawings for now. But all the other accounts, which are the statements you see them in?
This would be income statement.
The personal and the real?
The balance sheet.
The balance sheet. It's there in the balance sheet. So here what? Traditionally we say personal and real accounts are reflected on the balance sheet because what? Those accounts accumulate information across accounting period. In other words, they carry forward to the next accounting period. But modern accounting now combines those two groups and call them permanent accounts. And they call them permanent because they carry forward information to the next accounting period. You remember you read something called the going concern concept? So the business has, have no intention of stopping doing what you're doing anytime soon. So what is there at the end of one accounting period on these accounts are the ending balances. So they will now be the opening balances for the next accounting period. They are permanent accounts. Now look at the nominal accounts, guys. Look at the nominal accounts. Don't those are the accounts that you would have seen in the income statement and the statement of owner's equity? We will have seen the drawings there. Not true. Now remember the heading for the income statement and for the statement of owner's equity. They say for period ended. So it means that those accounts, whatever is on them, gone for that period. They relate only to that period. So the old school used to say that nominal accounts are reflected on the income statement. But contemporary accounting now say, listen now, nominal accounts are temporary accounts. In other words, they hold information just for the particular accounting period. So we're doing the accounts for 2021. The revenues, expenses, gains, and losses relating to 2021 and drawings. When we finish 2021, they are behind us. So what we do, we say we close out those accounts. We close them out. Whereas the other accounts now on the balance sheet, they are going to go forward to the next accounting period. They are permanent in that sense. So remember, guys, permanent accounts, because they carry forward information, they are reflected on our balance sheet. Temporary accounts, because they hold the information just for a period, then we will see them in the income statement or the statement of owner's equity. Now, drawings, guys. If you look at drawings, you know, technically, if you remember this statement of owner's equity is like we're taking it out, not like we take it out. So we could have said it is really a contra equity account. It reduces the owner investment. That's what drawings does. So it is personal in that it relates to a person. But it is nominal in the sense that it is closed out at the end of the accounting period. All right? So remember, guys, types of accounts. Now, we're talking about financial accounting. Now, financial accounting is founded upon what we call the double entry system. Now, this double entry system simply means that every business event, remember we call business events are referred to as transactions. Every business transaction is going to be affecting at least 2 accounts. And so in financial accounting, we speak about double entry bookkeeping. And in this double entry bookkeeping is where we speak about debits and credits. So because we have this dual effect with debit and with credit, so it means at the end of the day, guys, our total debits must be equal to our total credits. Now, I don't want anybody to be crying like me when I was doing accounts and didn't understand what they meant by debit or credit. And believe it or not, I did accounts for the very first time when I went to the university. Always a science student. So what we mean by this debit and credit? The debit and credit, I can best explain it by looking at what they call the T account. So the T account, guys, is a literal T, capital T. So in this T, they write the name of the account or the account title at the top like that. The left-hand side, they call it the debit side. And it is denoted DR, doctor. The right-hand side, they call it the credit side. And it's denoted CR. So when we talk about T account, nowadays in the modern days, they're doing columnar account. But because I know a lot of us doing accounts for the first time, we're going to stay with our traditional T. And I hope you printed off that file that is short that I gave you online with the T accounts. If you didn't, you're going to have to rule them up. But don't worry yourself. Quickly we rule up as we go through. Now, in order for us to do some true accounting, we need to understand a few basics. Now, we spoke about the expanded accounting equation. So make we see now how this debit and credit ties into these elements that we spoke about. So we have to look at normal account balances. And when we talk about normal account balance, it is really the side on the account that is increased. So we're going to look at the name of the account, the normal balance it carries, what we would need to do to increase it, what we would need to decrease it. Easy, easy thing. Now, if this one is not too easy, I'm going to show you another one that you can use that should be easier yet. Assets. You have to know, guys. I'm going to help you with a little mnemonic when I finish going through these. Assets, guys, normally carry debit balances. So if we increase in the asset account, we have to debit it. And if reducing it, we have to credit it. Next, I'm taking expenses. And I'm doing it in this order just to give you the little mnemonic. Expenses, like assets, carry debit balances. Because guys, if you think about it, let's take an expense like wages and salaries. When an organization pays its employees wages and salaries, shouldn't the organization be benefiting from the service that they give them, that the employees give in? Just like how when you buy assets, you're using it to enhance your earning power. So our service as employees is supposed to enhance the earning power of the business. Debit balance it carry too. So to increase an expense, you debit it, and to decrease it, you credit it. Drawings. Remember, drawings is not an expense, but we saw that it serves to reduce owner's equity. So drawings carry a debit balance. If we want to increase it, debit; to decrease, we credit. Liabilities. Remember, liabilities is on the other side. Liabilities normally carry credit balances. So if we want to increase a liability account, we credit the account, and if we want to bring it down, it's a debit. Revenues. Now, if expenses carry debit balance, then revenues, credit. To increase, credit. To decrease, debit. And the last one is capital. Capital or owner's equity, that one carries a credit balance. So to increase, credit; to decrease, debit. Now I want you to look at the first letter in each of these coming down. A, E, W, L, R, C. Those doing accounts for the first time, know this little mnemonic. Accounting ethics will lower the risk of corruption. Accounting ethics will, or debit, lower the risk of corruption, all credit. If that is a little bit too difficult for you to remember, let me show you another way you could go. Take the T account. Fix it in the accounting equation. Remember, guys, the left side is the debit side, the right side is the credit side. See the accounting equation there. So, if you look at this, assets on the side, that is debit. So asset have debit balance. Yeah? Liabilities and owner's equity on the credit side, credit balances. All right? Let we talk about revenue now. Don't we know that revenue serves to increase owner's equity? So if revenue increase owner's equity, then how much credit balance it have to? Expenses decrease owner's equity. So now must debit, so does withdrawals. And we know that, yes, from we identify the normal balance. If we want to increase, it's on the same side. And if we want to decrease, it's on the opposite side. So you can use the T account to help you to remember these things. All right, guys? Very easy. The next thing that you need to know before we get in the action is a chart of accounts. When they talk about—
go back 1 second, please.
Okay, my darling. There we go.
Thank you, Miss.
Okay, you're most welcome, dear. So our chart of accounts, all there is to this chart of accounts, it just listed all the accounts titles and their unique numbers. And notice, guys, the accounts titles will vary from organization to organization. So when you move across organization, somebody might call the account this in their business and another business call it another, give it another title. But they are going to be related to the different elements. So how they normally list them, and see how your balance the first, like your property equipment, your cash, your accounts receivable, your notes receivable, all there first. Then they list the liabilities. So like your payables, your loans. Then they put in the owner's equity related things. So like your capital, beginning capital, your drawings, those will be listed third. Then fourthly, they put in the revenues. So like your service revenue, your sales revenue, whatever the type of business is. And then fifthly, they'll put in the expenses. So that's how the chart of accounts is normally laid out. All right? So having cleared up that, let us take on the financial accounting cycle. So starting now, we're in the financial accounting cycle, and we are going to be going through the financial accounting cycle. For the next 2-3 weeks, that's where we are going to dwell, the financial accounting cycle. Now, remember we said that the financial accounting cycle is the process by which accountants prepare the financial statements. Now, in the first week that we met, we said that accounting is an information system. And in this information system, we started off with business activities. And the business activities, remember we said that they are really business transactions. Now, what are these business transactions? You remember we saw that the data from these business events could be extracted from some documents. You remember what we call those documents again?
Source documents.
Source documents, beautiful. Source documents. So how do we define a business transaction? A business transaction is any economic event, any business event that can be reliably recorded. Remember the qualitative characteristics of financial information. Reliability. They must be reliable. Because outsiders are depending on that information to make decisions about the entity. Now, every business event is going to be affecting the financial position of the business. Every single one. When we look at accounting equation, side, we increase one side, we increase the other side. Reduce one side, we reduce the other side. If it's every same side, one go up, one go down. Affects the data is kept. So source document we spoke about it. Give me an example of a source document.
Invoice.
Invoices, receipts. We have to have those documents to start the accounting cycle. So in other words, these source documents, they are objective, are verifiable. No, they who verifies?
Excuse me, miss, you were breaking up just now.
Matthew, who verifies financial information?
It's an auditor.
The auditor. So because the auditor is going to be verifying the accuracy of that information, it means that those source documents, you must put them away. So when the auditor comes, you can hand them to them so that they can verify what you have. So the financial accounting cycle begins with business transactions. Yes? Now, those business transactions, the next phase of the cycle, guys, and I'm going to remove these so I can put in the next phase. The next phase is to record these transactions in our journal. We make a note of them, or in accounting, we say we journalize the transactions. Now, after we journalize or record the transactions, the next step of the cycle is to post them to the ledger. Now, guys, the ledger is where all the action takes place. The ledger, this is where all the action takes place. So notice the terms, guys. We record in the journal. We post to the ledger. Now, remember we said that in bookkeeping, we are doing the debit and the credit. So at the end of the day, our total debits must be equal to our total credits. Now, to check that this is indeed so, the next phase of the accounting cycle, the accountant is going to extract what we call an unadjusted trial balance, abbreviated TB. Now, why do we say an adjusted trial balance. There could have been, guys, transactions that took place during the accounting period that were not journalized, nor were they posted. Remember I said to you, supposing we are doing the statements for 2021. And suppose when we reach the end of 2021, we find that, oh, you know that some persons should have gotten paid in 2021, their salary, but we owe them. It relates to 2021, so we have to show it in 2021. We never journalize it, we never post it. So what we have to do as the accountant now, we have to make what we call adjustments. So things that happened during the period that were neither journalized nor posted, we have to make adjustments for them because they relate to the period. So when we do these adjustments, we come up with a new trial balance that we call an adjusted trial balance. Now remember what the accountant is doing, you know, in the financial accounting cycle. Remember, it's a process they're going through to prepare what? The final statements. So the next phase of the cycle is to take this adjusted TB now and prepare those final accounts. Now, after we prepare those final accounts, we are going to be making what we call some closing entries. Because there are some accounts, we don't want to see them again. The information that they contain, gone. They are behind us. Yes? Remember the income statement, guys? Yes. So we're making sure that those accounts are gone off the books. Yes? So what is left now? Now the balances that are there, remember we talk about temporary and permanent accounts. So the temporary accounts gone. The permanent accounts now, they are there on the balance sheet. So we're going to put those in what is called a post-closing TB. So those balances, now the opening balances for the next accounting period. Then now, new business transactions going to come in. Are we going to record them, post them, and we go around again? It's so it goes. All right? Now here what we're going to do. We are going to be going through the entire accounting cycle. But you see this phase of it called adjustments? It needs serious focus. So here what we're going to do, starting today. We have our transactions because we're going to revisit a question that we did last week. We're going to journalize them. Then we're going to post them to our leisure. Then we're going to do our unadjusted trial balance. Then we're going to cut cross now and do up our final accounts and our closing entries, right? It's how we're going to do it. Then after we get some confidence now, we're going to go back and tackle adjustments. So I'm going to quickly explain to you what we mean by journalizing and demonstrate it, what we mean by posting and demonstrate it, and then we're going to revisit that question that we did last week, question 2. All right, Grayson. So, journalizing transactions. So this, guys, if you go back to the first week, you know, you remember the information system, the business activities, Then we talk about the data from the business, from the source document. Then you remember there was a section there that I call the action center, where we're going to generate the statements. So we are now in the action center, the accounting processing. So the journals, another name for journals, books of original entry. Or I just like to say it's our little diary. Because all we're doing is to make note of the transaction. I remember we're doing accounting. So we have to think about date. So the transactions are listed chronologically in order of date. Now, in some businesses, they just operate one journal. But if you're dealing with hundreds, thousands of transactions, you may have to take on what we call subsidiary or special journals. Now, each subsidiary journal is used to record a specific transaction. So, supposing you have a lot of customers, what owe you? You operate what we call a sales journal. Now, when you take up the sales journal, anybody's name that is in that sales journal, you know that they owe you because it is dealing with credit sales. Are you there? Once a name in there. If you have a lot of suppliers, you would want to operate a purchases journal. So once you took up a purchases journal and I see a name in there, I know it is somebody who I owe, I mean in the business. Your cash book is a journal. And guys, you need to understand, cash book is a journal and a ledger. Because that is where you record all cash and bank transactions. Now, there are some transactions that don't fit into none of the subsidiary journals. Or maybe, as I say, you could just be operating one journal. If that is the case, you call that journal a general journal. So if it's just one journal the business is operating, it's a general journal. If they're operating subsidiary journals, they must also have a general journal. Because the general journal is used to record all the transactions that is not in a subsidiary journal. No. Remember, I said to you that if I take up the sales journal and know, if I say J Stone in it and know, say, yes, J Stone owes me some money. If I take up the purchases journal and I say Wilbert Black, I know that, yes, Wilbert, I owe Wilbert. But if I take up the general journal, guys, and I see J Stone, I'm going to ask a question, is what this? What is J Stone? If I go back and go search something. So look here. Every transaction that you record in the general journal, as the accountant, there must be a little note And that note in accounts, we refer to it as a narration. You have to tell people what this transaction is about. So remember, every single transaction that is recorded in the general journal must be followed by a narration. But if it's in a subsidiary journal, you don't have to write any note because it is explanatory. So in the general journal, we use debits and credits to record the changes or to record the transaction. So make we do a little demonstration in the interest of those who have never done accounts before. When you journalize it, the first thing you do, you're going to look at the transaction and you're going to identify each account affected and the type of account. When we say type, is it asset? Is it liability? Is it owner's equity? Is it revenue? Is it expense? Is it drawings? Now, having identified the account and the type, you're going to ask yourself, did the account go up or did the account go down? You see why you need to understand the normal accounts and their normal balances and to know whether you need to debit or credit. But I'm going to even teach you an easier way you can know. And after you do that, you apply the rule of debit and credit. Now, look at this little example. On January 2, A. Matthews invests $35,000 of personal funds to start the business. Yes? Make we go through the rules. The first thing, identify each account affected. So Matthews is investing cash in the business. So the accounts affected would be, talk to me.
Cash and capital.
Cash and capital. Cash would be an asset account. Yes?
Yes.
Nathaniel, what kind of break time you're talking about? No. Cash is an asset and capital there. So cash increase. Not true. What about capital? What happened to capital?
It also increases.
It also increased. Guys, go back to last week. What we do, you know? Look at the accounting equation. Asset on the one side, liabilities, owner's equity on the other side. If one go up, asset go up, the other one have to go up too. So the two of them increase. Yes. So we know now, to increase the asset account, we're going to debit it because it normally carry a debit balance. To increase capital, we're going to credit it, not true, because it normally carries a credit balance. So you see the double entry thing at work? Yes. So how the journal go and look? See the journal there? So we rule it up like that. The date column, a column for the account and explanation, the names of the accounts. Explanation is the narration they're talking about. Then there's a folio column. I'll explain that to you in a bit. What would be there, so? And what is debited, credited. So this is how you would do. Yes, there?
Miss, the account name would be like A. Matthews, A. Matthews. And then you would have put the
Cash.
the cash and the debit and then the credit for and the capital and the credit.
Beautiful. Guys, under the date column, look at the date, January 2. Yes. Now, the account that is debited or the receiving account is always written first. So here, cash is debited 35,000. Every recorded in the general journal must be followed by a narration. That is just telling us what this transaction is about. So just write as it is. It's investment by the owner. That's all it is. Now, remember, this is a journal. So now we need to post to the ledger. We have made note of the transaction here. So let's now go over to the ledger. Now, guys, a little rule I'm going to teach you. You see, after you identify the accounts affected, just ask yourself, which of them is receiving and which is giving? The one that is receiving is always debited, no matter which type it is. And the one that is giving is always credited. So like this one, you identify cash and Matthew's capital. Which is receiving? No cash. Which is giving? No capital. So you debit cash, your credit capital. We're going to do that for all of the transactions when we're going through the question.
Miss?
Yes, darling?
This is the folio brought forward.
No, the folio column. Remember, we're going out to the ledger. The folio column is going to point you to the page in the ledger where you can find the matching T accounts. Because remember, you journalize and then you post. So the folio column going to tell me where in the ledger I'm going to find the matching T accounts. So I give you the page number. So the ledgers now, guys. The ledger is the action book. Action book. The Now, each account is going to give us a detailed record of the change in the particular asset, liability, capital, revenue, expense.
Miss,
Drawing. All of them. Now, remember, we said that we post to the ledger.
Miss, excuse me, Miss.
Yes, darling?
Miss, we didn't hear anything after you started ledger. You just broke out completely.
Okay. Ledgers, they contain all the accounts that are utilized by the entity. All the accounts. And I'm saying to you, the account, that T account, is giving us a detailed record of the changes. So we say we post to the ledger. We post to the ledger. When we say we post, posting is really just transferring the information from the journal to the ledger. Now, each journal is going to have a matching ledger. So you have a sales journal, you have a sales ledger. A purchases journal, a purchases ledger. Your general journal, your general ledger. So you would have general ledgers and subsidiary ledgers. But look here. If you operate subsidiary ledgers, and I want my people who do accounts already to listen to me, and because I want you to answer this question. If you operate subsidiary ledgers, supposing a sales ledger, so you have 3 customers, A, B, and C. So in the subsidiary ledger, I'm going to see a T account for A, a T account for B, and a T account for C. In the general ledger, you must have one account which is going to summarize the contents of that subsidiary ledger. One T account, which is going to summarize the content of the sales ledger, the content of the purchases ledger. What you call that one account? I want somebody who has an account before to tell me. What you call that big T account that is summarizing all the T accounts in the subsidiary ledger? What you call it? Where are my Cape people? You ever hear something called a control account? Like to talk about the sales ledger control, the purchases ledger control. That's the bigger T account that is there in the general ledger. So each subsidiary ledger, guys, must have in the general ledger an account which summarizes the content of that subsidiary ledger. And that account is referred to as a control account. Yes. So it means that when I add up the individual balances, A, B, and C in that subsidiary ledger, when I look at that big T account in the general ledger, is that balance I must see there? The sum of all those individual balances. Don't worry yourself, we'll get there. So let us post the transaction that we recorded earlier on. So remember with T account, cash account is 1, Matthew's capital. Now guys, I know that those of you who do accounts in high school already, you like to do a lot of writing. You see here, we just want to make sure so we get the figure on the right side. So remember the journal said we are to debit cash. And we're to credit Matthew's capital. So see it here? On the debit side of cash, 35,000. We put a little superscript to say it is transaction A. And we're going to capital and see it here on the credit side. So we have recorded, we have posted. All right. Now, most businesses you will find, guys, they are computerized and they have computerized accounting systems. So in those computerized systems, as soon as you journalize the transaction, the ledger accounts are going to be updated. As soon as you journalize, automatically it is posted. So then, for the rest of the session, let us get busy. So we're going to go back to that question 2 that we did last time. So let me get my worksheet here. Remember those T accounts, guys? I gave you them already. If you don't have them, you're going to have to be opening some T accounts with their opening balances. Remembering that question, cash had an opening balance of 1,720. Accounts receivable had an opening balance of 3,240. Land has an opening balance of 24,1. Those are all debit balances. Remember, we learned that assets carry debit balances. Liabilities, accounts payable would have a credit balance of 5,4. And Grayson Capital has a credit balance of 23,660. So we are now going to be doing up our journal entries. So taking our time now, we're doing formal accounting now. So the first transaction, Grayson received 12,000 as a gift and deposited the cash in the business bank account. So we identified the accounts affected. And Grayson Capital. Cash is receiving from Grayson Capital. So for that transaction, transaction A, we debit cash, 12,000. And we are going to credit Grayson Capital, 12,000. This is the general journal. So we know we'll have to follow it with the narration. That is owner investment. Now, guys, what we are going to be doing as we journalize, we are going to post. Them. So my cash account, see there it has an open balance of 170. So my cash has an opening balance of 1,720. Capital has an opening balance of 23,660. So the journal entry says I am to debit cash and I am to credit capital. So on the debit side of the cash account, see I put in my 12,000 there. Work with me, guys. And I go to my capital account, and on the credit side, I put in my 12,000. So we have journalized, we have posted. We have journalized, and we have posted. So let's now go to the second transaction. We paid off the beginning balance on accounts payable. The balance on accounts payable is 5,400. Remember, guys, the little rule. Identify the accounts affected. Since we paid off that balance, what are the accounts affected?
Cash and accounts payable.
Cash and accounts payable. Remember, you know, we did this last week, you know, but we're only formalizing the thing now. So which is receiving? Follow my little rule. Which of the accounts is receiving?
Accounts payable.
accounts payable. So we're going to debit accounts payable. And cash is given, so we credit cash. And the little note, we're paying off suppliers. So go to your accounts payable T account, guys. And on the debit side, put in 5,400 and put it to superscript B. And then you go to your cash account and on the credit side, put in 5,400 with a little superscript. Let me do C and then I'll show you what the T account would look like. C. C says, we perform services for a client. We got cash of 1-1. So here, guys, we earned some revenues. Yes, we got cash. So the accounts affected would be cash and service revenue. We received cash. So the journal entry is going to say debit cash 1-1 and we credit service revenue 1-1. And we put our little note. We perform service and received cash. Let us see what our T account should look like at this time. And then for all the others, we're just going to go through. And then at the end, I show you the T accounts. So what the cash account look like now? See how the cash account look now? Showing the 3 transactions that we have done so far. See how the accounts payable account look now? Make sure yours look just like this. And make we look at the revenue. How the revenue one look? See it there? 1-1. All right. So let us go now to transaction D. So we're going back to our journal. So transaction D, what it says, we collected cash from a customer on account. We collected cash. So cash is one account affected. Getting cash from the customer. Which account relates to your customer?
Account receivable.
Account receivable, beautiful. So it therefore means we would debit our cash account, 750, and we credit account receivable, 750. And we put our little note. We received cash from customer. So please go to your T accounts. On the debit side of the cash account, put in that 750. Go to accounts receivable T. And on the credit side, put in 750. That's transaction D. Let's go to transaction E. Transaction E says, we purchase supplies on account, 720. So supplies is one account. We purchase the supplies on account. So remember that we owe for it. So when we owe, what we call that account again? When we owe, what's the name of that account?
Payables.
Accounts payable.
Accounts payable.
Accounts payable it is indeed. So supplies is receiving. So we debit supplies. The supplier is a given. So we credit accounts payable. and we put our little note, purchase supplies on account. So go to your T accounts. On the debit side of the supplies account, put in 720. Go to accounts payable, and on the credit side, you put in 720. All right? So we go now to transaction F. Consulted on the interior design of a building. Remember, it's a service entity, and we billed the client for services rendered, 5,000 on account. So here again, guys, we have earned some revenues, but this time the customer owes us. So when the customer owes you, what you call it again?
Receivable.
Receivables, accounts receivable. So the journal entry for that one is going to say, debit accounts receivable, 5,000. We have earned revenue, so we are going to credit our service revenue, 5,000. And here we perform service on account. So go to your accounts. On the debit side of the account receivable, you put in 5,000. And on the credit side of the revenue, we put in 5,000. So that is transaction F. We go to transaction G. That one now, it says we invested personal cash of 1.7 in the business. Accounts affected, cash without a doubt. And we are investing. So what's the other account? The owner is investing. So what's the other account?
It's capital.
Capital indeed. So here, this one, debit cash 1.7, credit Grayson capital 1.7. And this is investment by the owner. So go to your cash account. On the debit side, put in 1.7. Go to capital immediately. On the credit side, put in 1.7. Transaction H. The following, we paid office rent and we paid advertising. First one, we paid office rent. So the accounts affected there will be office rent, and since we paid, the other account would have to be what?
Cash.
Cash indeed. So office rent is given and expense from cash. So we debit office rent expense and we credit cash 1.2. So go to the T accounts. On the debit side of the office rent expense, you put in 1.2. Go to the cash account, and on the credit side, you put in 1.2. Repeat the same thing for advertising. Debit advertising expense, 600. And we paid it out of cash. We paid some cash expenses. Coming down. Transaction I. We sold supplies to another interior designer for $80 cash, which was the cost of the supplies. So what are the accounts affected here?
Supplies and cash.
Supplies and cash. So we got cash from giving up supplies. So here, debit cash, 80. Credit supplies, 80. So we go to a cash account. On the debit side, put in that 80. Go to supplies. On the credit side, put in that 80. And now we're at the last one. Withdrew cash of 24 for personal use. What we call it again?
Drawings.
Drawings. So Grayson took out cash. Drawings is receiving from cash. So the J would say, debit B Grayson drawings 24. Credit cash 24. Owner withdrawal. So go to your T accounts. On the debit side of the drawings account, put in 24. Go to cash. We're decreasing cash. On the credit side, you put in 24. All right. Now is the moment of reckoning. Now remember we say, guys, after we journalize and we post, we need to check now to ensure that total debits equal total credits. So what we have to do now, guys, is what we call balancing of the accounts. So let us go to the cash account. You saw your cash account look? Make sure you saw it look. See the cash account there? So how we balance the account now? Watch me. Remember that cash is an asset account. So we expect it to have a debit balance. Yeah, that's the norm. So here are all your balance accounts now. Those who are doing accounts for the first time. You're going to add up everything that is on the debit side. And when we total the debit side, it comes to 17,350. When we add up what is on the credit side, it comes to 9,600. Now, the balance on any account is going to be on the side with the bigger amount. Yes? It's always on the side with the bigger amount. So this is how we balance accounts, guys. We take the bigger figure. It's a T, the account must balance. So 17,350, 17,350. What is the balance on this account? We find the difference between 17,350 and 9,600. What do you get?
7,750.
7,750. So my non-accountants, we have a thing we call CD and BD. So the balance CD is on the side where the shortfall is, basically. So we're putting that missing piece. It balanced with the other side. And then now, so the next period is opening with a debit balance, because this balance BD is saying that the debit side is 7,750 more than the credit side. So it's a debit balance. So that is our cash account. Let's take another account, account receivable. Now, when you look at the account receivable, the total of the debits, 3,240 plus 5,000. That is 8,240. On the credit side, we have 750. So 8240 is the bigger figure. Yes? So what is the balance on this account, guys? 8240 minus 750. What is that balance?
7,490.
7,490. So we say balance CD. So this account has a debit balance of 7,490. Make we see if we can balance even one more before you leave, or two more. Two is on this page. Make we balance off these two. Supplies. The bigger figure on the debit side. 720. Yes? The difference between 720 and 80.
640.
640. So we say supplies as a debit balance of 640. Land. There was no transaction on the land account. Not true. So it just have a balance brought down of 24,1. Hear what you're going to do for me until next week. And based on what persons are saying, may very
Miss, you're breaking up. So after you
yes, I'm saying to you, next week, persons are complaining.
Miss, you're breaking up again.
So there's a problem with the size of the room and the registration. Understand? No complaining.
Miss, but all of us never agree to that.
Miss, we never hear anything.
I never hear any of that.
No, I'm saying to you. You're in me now?
Yes, miss.
All right, I'm saying to you, persons did complain that why is it that we are not face to face? I explained to you that the size of the class is much more than the room.
Miss, with all due respect, miss, all of us didn't agree to that, miss. And you'd have said earlier that some of the students can actually go to the other classes.
Yes.
So it would be unfair for all of us to
I've said
actually
it,
attend.
but then there are persons who seem to have an issue, and I want to make sure that everybody is okay.
Miss, I understand that, miss, but the lecture is for 2 hours, miss. So the persons who can't fit, they're gonna stand for the 2 hours.
And that wouldn't be fair. So those who want to go to the face-to-face ones, you have that